Hi everyone and welcome to In the Money. I think it's always a good idea on Friday to recap the week that was in the financial markets, and this week was certainly an interesting one. This was the first week of 2023 that ended lower across broad swaths of the market. The economy faced its first headwinds of the new year, and the optimism that has characterized the financial markets in recent days seemed to take the week off. Referencing the S&P 500 ETF, SPY, we can see that the markets seemed to rally into Tuesday, bounced around a bit, and then faded to end the week lower by 0.17%. Although SPY ended flat, there was notable intraday volatility. The reason for the lack of enthusiasm this week was that the markets are processing the Fed's 25 basis point increase in rates and last week's surprisingly robust jobs report. Also, earnings season is almost over, with many institutions falling short of analysts' expected earnings. Take for example Lyft, which fell short of analyst expectations in its earnings and fell 36% day over day on Friday. The performance of the SPY so far in 2023 would suggest that investors were expecting a near-perfect execution where inflation abates while at the same time the economy continues to grow. This week was a bit of a needed reality check to that point of view and a reminder that we don't yet have the juice for a sustained bull market. Another reason for caution is that the jobs report of last week increases the odds that the Fed will keep tighter monetary policy longer than investors hoped. We should keep in mind that a strong jobs report is good for the economy but can be bad for stocks, especially nowadays, because it suggests that the Fed will keep tighter monetary policy with higher interest rates for longer. We can also point to Fed Chair Jerome Powell, who indicated the same and suggested that the target inflation rate will take some time to reach. Now look at the other major indices. We see that QQQ fell by around 2% for the week, and the Dow Jones Industrial was essentially flat, increasing 0.04% week over week. The major takeaway is that investors are doubting that the Fed can bring down inflation without hurting the broader economy. We can look to the options market to see how investors have changed their mood. The put-to-call ratio for a broad set of equities and indices increased over the week, suggesting that options traders have been buying more put options than call options. Recall that put option buying is buying protection against a downturn. Also, the VIX has increased over the week, suggesting that volatility has driven up option premiums. That is good for non-directional options traders who sell covered calls and cash-secured puts. The oil markets experienced some turbulence on Friday after Russia announced its intention to cut output starting in March. Less supply will surely drive up demand and prices, and Brent rose about 2% on Friday. The other catalyst that might drive up oil prices in coming months is the reopening of China after severe COVID restrictions. We will be on the lookout for trading opportunities in XLE, which is the SPDR ETF sector ETF for energy. Next week, we will have more news to look forward to, including the CPI Consumer Price Index for January and a few more earnings. I would expect further volatility heading into the new week. I hope you have a nice weekend and clear your mind before we head into the new week. If you enjoyed this content, please subscribe and leave a comment for how we can improve these videos.